Always write down these variables when you're doing a depreciation question. Make sure you know their cost, your salvage value, your depreciable cost, also your residual cost. The 10,000 minus the 1,000 is the 9,000, which is the depreciable cost. Cost minus salvage value is depreciable cost. In useful life, we have the accounting periods, 5 years, and then we might have units here. So cost minus salvage value over estimated useful life is depreciation expense over the straight line method. You'll have to memorize the formulas for each method. Straight line method, relatively simple. I'm not going to stay here too long because we've done it before. So cost minus salvage value, 9,000 divided by the 5 years, 1,800 per year. Then we'll just debit depreciation expense, credit accumulated depreciation. We had this on the exam. Some students there was a trick question there because it was for part of the year. So remember, if we get this in June or July, you have to account for the amount of months left or the amount of days left in the year and then allocate accordingly. So if this was half a year of depreciation, it'd be 900 for the first year and 1,800 for the subsequent years. So depreciation expense is always going to be even on the income statement, and the book value will decline evenly. Understanding how how the depreciation methods impact the balance sheet and income statement from a variable perspective, from a mathematic perspective, is very important. So make sure, if I ask on the exam, which depreciation expense method has an even recognition pattern on the income statement, I'd expect you to say the straight line method, because it's even on the income statement, even here. And then if we said if there's an even method of decline on the asset on the balance sheet, we'd say the straight line method. And then remember, accumulated depreciation was the first contra asset account we saw. It reduces the plant, property, and equipment value, and so our net plant, property, and equipment will be the 6,400 on our financial statements. Again, accumulated depreciation has a normal balance of a credit, machinery has a normal balance of a debit, and both are asset accounts. Accumulated depreciation is just a contra asset as it reduces the value of the asset machinery. And then here's a good example of a schedule. So 10,000 end value, depreciation 9,000. This is depreciable cost, 20%. Well, that's 1 divided by 5 is 20. And then we get an expense of 1,800. End of the period amortization, accumulated amortization is 1,800. This is our book value. And as we see, the accumulated amortization goes up by the expense, the book value goes down. I know these tables might seem a little confusing, but you have to get to know them because all of our long-term assets and long-term liabilities going forward are going to have similar tables. So please get familiar with this format. Everything you do in accounting is going to eventually be done in Excel, which pretty much is just this. So please get comfortable with this format and understand the formulas where this times this equals this, accumulated, so this equals this plus this equals 3,600, this plus this equals 5,400, and the end of the book value is just this minus this, this 10,000 minus this 10,000 minus 3,600, and so on and so forth. At the end of the life, we should get back down to the salvage value.